And now I will introduce today's event. In a December television interview, President-elect Barack Obama noted that he had been reading a book about Franklin D. Roosevelt's first 100 days in office, a highly appropriate choice given the intimidating list of problems facing the 44th United States President when he takes his oath of office next Sunday. Not since Roosevelt moved into the White House in the midst of the greatest economic crisis that country has ever faced has a U.S. president inherited such a challenging agenda. The labors Mr. Obama faces are Herculean: a failing auto industry and a growing recession, jobless claims spiking to their highest levels in more than a generation, a continuing crisis in the housing market, the disappearance or fundamental alteration of all 5 major U.S. investment banks, and a national deficit that defies comprehension. Our guest speaker today will focus on the economic challenges facing the new president. He'll also take a look at how the American banks and the system regulating them stand up to our own in Canada. What have Canadian banks done that has so far insulated them from the astonishing meltdown south of the border? Robert Kelly is Chairman and CEO of the Bank of New York Mellon, a worldwide leader in asset management and security servicing. Operating in 34 countries, Mellon has total assets of $196 billion and a market capitalization of $43 billion. Prior to joining Mellon, Mr. Kelly served as Chief Financial Officer of Wachovia Corporation, and previous to that, he spent 19 years with Toronto Dominion Bank, where he served ultimately as Vice Chair. He was named one of America's best CFOs by the readers of Institutional Investor magazine in 2004, 2005, and 2006. So obviously he's been doing something right for a while. Ladies and gentlemen, please welcome the Chairman and CEO of the Bank of New York Mellon Corporation, Mr. Robert Kelly.
Well, good afternoon, everyone, and thank you. It's a real pleasure to be here. I wanted to just acknowledge a couple of people here at the head table. Jerry McCaughey, who's been a great partner for 12 years with CIBC Mellon, and Tom McMillan, who's been running it and built a huge business here in Canada. We have about 1,600 people in Canada, and I promised I would mention him because it would help him with his business plan this year. And I can't be at the head table without mentioning Robin Courtaulds. I've been in business now for 33 years, and he was by far my best boss I ever had, and taught me more things that I ever should have known, really. And I do remember at one point Robin told me that in fact, when you're president of a big Canadian bank, you only have to make 1, maybe 2 hard decisions each year. And I remember thinking about that last fall, because I swear I was doing it like once every 3 days. It was unbelievable. But it is great to be back home again. Our daughter was born here. It's great to be back in Toronto and back in Canada. And more importantly, it's actually really great to get outside of New York City. It's just so depressing there right now. Now, in preparation for today, I spent a little bit of time preparing a comparative economic scorecard of how these 2 great countries are doing on both sides of the 49th parallel. So I'll tell you what I found up front before I get into the other subject matter. So firstly, your unemployment rate is lower than the U.S. Your GDP rate is higher. You enjoy budget surpluses, very slight of course, versus huge deficits in the U.S. You have trade surpluses versus trade deficits in the U.S. Your housing prices have done better than the U.S., and your mortgage market actually exists in this country. Your individual savings rates are higher in Canada than in the United States, although Americans are finally starting to save. Canada has a stronger banking system, there's no question. We could talk about that for hours, but perhaps the best way to think about it is in terms of how the stock market thought about it. And last year, the Canadian banks were down 35% in terms of total return. The U.S. banks, on average, were down 51%, and just for the record, we were down 40%, kind of in the middle. It's been an incredibly tough year for the U.S. banking system, and I'll come back to that. We also track corporate tax rates in the 34 countries in which we operate in around the world. And the good news is Canada beats the U.S. It's astonishing. It wouldn't have been the case 10 years ago. Canadians' corporate tax rate at the margin is about 33%. In the U.S., it's 40.5%. The bad news is of all of those countries, Canada has the 5th highest tax rate in the world, which is too high for this country. And disappointingly, even more, is the U.S. now has the highest tax rate, corporate tax rate on the planet of all the countries we measure. And last year it was second worst, second only to Japan, but we've managed to move into the highest snack bracket. That's not a good thing in a globally competitive world. Furthermore, when you move on from the basic economic stuff, I've also noted that Canada seems to have a federal election every year or so, and it does not cost $1 billion every time you have one. So I had to conclude from that Canada has a stronger and more efficient democracy. And and I could go on with other kind of data, but I'm going to end with my favorites. Of course, you have lots of oil and gas. Your kids actually test better in standardized math and science tests, and on average, you live 2 years longer than Americans. So basically, you should be absolutely giddy about your relative place in the world right now. Now, of course, in absolute terms, our economies are weakening, and they're going to continue to do so this year, and you're going to get lots of bad economic news. I saw a great stat in Barron's magazine a week ago. It said that on a 10-year basis, our stock market has had its worst 10-year run since the 1820s. That's the 1820s. I don't know if you recall when the Dow hit 10,000 for the first time, but it was actually March of 1999, which is amazing. That's in a couple more months, that'll be 10 years. GDP could actually be -5 to -7% in the fourth quarter. We won't know that till the end of January. Unemployment rates at 6.7. I have no idea where it's going to peak. The worst I saw in looking back at the records, ignoring the Great Depression, which this is not, and nor will it be, it does appear that the highest rate of unemployment in the U.S. was in '82, which was almost 11%, 10.8%. So it's not a stretch to imagine us going easily above 9% south of the border. But '82 was a very, very brutal time if you were working at that point. We only lost 25 banks in the United States last year. That's actually almost none. It is by Canadian standards. It's huge, of course, but there's 8,300 banks in the U.S. All of the mortgage banks either disappeared or were acquired, or became part of the U.S. government. So you think of Fannie and Freddie and Countrywide and the others. It's been amazing. And, of course, we had 5 investment dealers, and they're either banks or they're part of larger organizations or gone now. So we have some challenges. And as you know, the U.S. has just had a very historic election. When President-elect Obama is inaugurated in 8 days, he's going to have some big challenges, and everyone knows it. Everyone's very hopeful. There is a wonderful attitude in the U.S., a bipartisan attitude of let's get this thing behind us, let's deal with it. There are some big issues, and I'm going to talk to just 3 of them. The economy, healthcare, and retirement funding. I know mostly stuff about the economy, so I'll keep it really short on the last 2. First of all, the economy. In the aftermath of the credit crisis, particularly after the Lehman demise, where that same weekend that Merrill Lynch disappeared and AIG basically had to be bailed out, we walked, as a country, we walked right to the edge of the cliff. There was a complete lockup of the credit system in the United States. It was absolutely astonishing, and the U.S. commercial, short-term commercial paper market and short-term funding market, which is about a $10 trillion market, and about half of it's government paper, so the rest of it is bank and corporate paper. It was disappearing at the rate of about, we estimate, about $50 billion a day. So companies basically couldn't fund themselves. There was unbelievably massive, historic, and creative things that the Treasury and the Fed and other government officials did in the United States. And it was astonishing how much liquidity was actually injected and the impact it's really had. Now, what you're seeing a lot of right now south of the border and probably up here as well is a lot of armchair, second-guessing, hindsight stuff about how well some of these programs worked and didn't work, and were they papered right, and did we have the right administration around it. This was done in emergency mode. Not all of those plans and the actions were perfect, but I can tell you it worked. The system is much better today than it was in October. The economy is still bad, and the banks aren't lending as much as they would have traditionally, but of course lending standards are now back to a more normalized level versus the go-go days of 06 and the first half of 07. But I would say that TARP and all the other activities that occurred at the time has really, really helped the U.S. financial system. So we're not going to see the full effect of these actions for a while yet. They're still working through. You've seen essentially what the effect of bringing interest rates to zero. At some point that'll be inflationary. The government is already starting to think about how do you get out of these programs. You can't underestimate the importance of that. In the normal course of events, the capital markets in the United States require a banking system that works, and it requires a capital market system that works. And when they aren't working, then you have a government system that helps. Well, the capital market system is completely shut down, and that's another discussion we could have. The banks, of course, are under extraordinary duress, and the government's been helping out massively. At some point, they've got to figure out how to extract ourselves from this system, and we've got to get the capital markets going again. Hopefully it won't be too far in the future. The biggest problem we faced, of course, and we're still facing it today, is the housing market. The housing market, last time I looked, was about an $18 trillion market in the U.S., and mortgage debt against that is about $10 trillion. Half of that is Fannie and Freddie. There were terrible excesses that happened in the U.S. that did not happen in this country because of the different banking system we have here and the mortgage origination system. One of the a CEO of a bank in Ohio told me about 6 months ago that 18% of the mortgage brokers in Ohio actually had criminal backgrounds. It's astonishing. It's just so sad. And that's got to change. That has absolutely got to change. The Case-Shiller Index shows that we're down 23% from the peak. If you look at it city by city, you can look at the 10-city type measure, and you can look at a 20-city measure. Of course, the Southeast and the Southwest are doing the worst. If you look at Miami or Phoenix, the housing market's down about 40% so far. Essentially, if you go to a Walmart and buy a toaster, you get a free house with it now. Now, what I will say, for all of you wonderful snowbirds or potential snowbirds, this is a great opportunity for you all. We've priced our mortgage-backed securities, and unfortunately we own some of these things, at assuming a 35 to 40% decline from peak to trough. And it's probably going to happen. It's amazing. And I don't know what that implies for those cities in the Southeast and the Southwest, but it's going to be tough. And I've also seen data that it's indicated if you bought a house for the first time after 02 or even 03, you're probably underwater. So there's a lot of things that's got to get done here to turn that problem around. A house is for the average American, it is 85% of their net worth. So if that net worth is flat or going down, you're not going to be spending as much. So we've got to get this problem stabilized. Foreclosures are going up, as you all know. There was a program in the U.S. during the 30s, during the Great Depression, where essentially if you had a job and you couldn't afford your mortgage payment, the government provided for 1.9 million households in the United States. It provided an ability for you to renegotiate your loan at a lower interest rate and extend term. It worked, and it didn't cost the government any money at all. Now, there's other ways you can do that through guarantees and stuff like that, but I know that the President-elect Obama is certainly thinking about it a lot, and there's probably things we need to do like that to cushion the further downward trend in housing prices that are occurring here in the U.S. You probably saw how the Fed is now buying mortgages. That's great. It's really been bringing down mortgage rates in the U.S. A lot of people hope we'll see a mortgage rate in the 450 type range. For a 30-year paper, I think it's around 530 right now. I think that's got to keep happening, particularly for all those mortgagees where you have resets occurring this year. If we have a 4.5% mortgage rate, that'll be good for everyone. In terms of what you should watch for, there's really two statistics, and it's not rocket science. Inventories are now at the level of about 12 months versus where they should be at 4 or 5 or 6 months. We got to start to see that inventory level starting to come down, and we also eventually have to start to see price declines, the relative speed of price declines to start to table off here and level out. I don't know when that's going to happen, hopefully in the second half of this year. That is the main issue, and until we solve housing, we're not going to be able to turn this around. Another thing you're going to see this year is a huge amount of regulatory reform. Clearly, there were excesses. There's issues in terms of a number of things that perhaps we should be doing better as a country in terms of how we regulate banks, hedge funds, insurance companies, financial systems generally, how we manage systemic risks. That is going to be a huge topic, and it will be dealt with, I would think, very early in this year. Last topic would probably be, from the economic standpoint, is the stimulus plans. The plans last year were big, and they weren't cheap. We're going to see more of them. I am a big believer in lower tax rates, as you could probably tell. They have to be not just one-year things or even two-year things. I think the average American has to believe they're actually going to be there for a long time. And I hope to see that, and along with other things that are being done, whether it's infrastructure programs or other things that we can do to help forestall foreclosures. But it's going to be a tough year. In terms of the banking system, in 91, 92, between, I think it was 1,100 or 1,200 banks disappeared, which is astonishing. The estimates in the U.S. at the moment is a couple hundred banks will disappear. That's probably true. I think of it in terms of kind of like three bubbles that are occurring. The bubble you've seen so far is the write-down in securities that are going on in the U.S. market. Eventually, that's going to tail off. I don't know when that is. Is it halfway through this year, or is it the end of this year? The next wave of losses that's going to occur is going to be in personal loans, whether they be auto loans or leases or credit cards or other forms of personal stuff, including home loans. And then eventually, at some point later this year, we're going to see more commercial real estate and other fun stuff like this. So I would think that the banking system will have losses this year that are pretty sizable, and the market is certainly expecting a disastrous fourth quarter when people start reporting over the next couple of weeks. And those losses will probably go through to next year. The thing you should remember, though, when you're seeing all those things, is that is not an indicator of what's going on in the economy. That's a lagging indicator, okay? That's all the junk on people's balance sheets that they've got to write off and get behind them. And we will get it behind us. And it's going to take some time. The fundamental earnings power of the U.S. financial system is about $220 billion a year pre-tax, pre-write-offs. So if we got another, let's say we've got another $500 billion to go of write-offs, who knows? I don't know. Then you got another couple of years of write-offs. We'll see. I'd be happy to talk about that more in the Q&A. Healthcare. President needs to deal with it. And the problem is, as you've probably seen all these graphs, the costs are absolutely escalating, and it's escalating rapidly. Most studies would indicate that the cost of healthcare is going to triple by 2020. Today in the United States, healthcare is 16% of GDP. In Canada, it's 10% of GDP, so you have a real competitive advantage from that respect, and the U.S. has some cost issues. I don't know what is the best healthcare system, and I get into a lot of trouble whenever I talk about it because everyone has such strong feelings on it. but I've lived in 3 countries, the U.S. and Canada and the U.K., and the U.K. has something that's kind of in between Canada and the U.S. There's a basic system for everyone, and then there is, if you want to invest in it, you can have a top-up plan. And Germany's doing the same thing now, and I think that makes an awful lot of sense. And of course, the other reality in the U.S. is there's 47 million citizens that are not insured, and I think that's, personally as a Canadian, I think that's a terrible thing. And that is certainly a plank on President Obama's agenda, which he hopes to end, and the question is, how will he make it happen? And finally, retirement funding. The Social Security system is unsustainable. You probably know that Austria was the first country to figure out that people should retire at 65. That was done during the 1860s, and how did they pick 65? It's because basically all men were dead at 65. So I'm glad we're through that little problem here. So I was reading recently that baby girls born right now probably have a pretty good shot of living to 100, which is amazing. So I actually like Canada's idea of the Canadian Pension Plan, CPP plan, of as you call it in the States, it's kind of a hybrid plan, is pay as you go or full funding. But I love the idea of putting the money aside for retirement. And there aren't a lot of countries doing it, and I think it's pretty brilliant, and you should be proud of it up here. I don't know what will happen with the retirement funding program and how it will work, but I'm sure it will involve some rise in retirement age and probably some change in the way benefits work and ultimately reductions. So before I make you too depressed, I'm going to wrap up on a positive note. We do have a new administration coming in. I think that'll be good for investor confidence, and people will be thinking differently, and they'll be a little more optimistic. Also, there's been 10 recessions since the Second World War. There's also been 10 recoveries. We always recover. It happens every time. And we will this time, too. And it's so easy to be really negative. We will get through this. We always do. Americans are impatient people. They want this problem behind us. They elected Obama to put this problem behind us. Now, it can't happen overnight, but we will get it behind us. Hopefully, we'll only have a couple of quarters of negative GDP growth, and then we'll start to rebuild from that, and hopefully we'll get housing stabilized. And finally, given that Canada's GDP is in large measure exported, 35% of the GDP of Canada is exported, mostly to the U.S. I would hope that you'd kind of be rooting for us, south of the border. I talk Canada up every time and every opportunity I get. I've had very little success, though, getting A into the vocabulary there. It's been a serious problem. So thank you very much. I'd be happy to answer any questions.
Thank you very much, Bob. Now we have 2 microphones that are wandering the room looking for questioners. And I'll turn over my hosting duties after this point to Noella Mellon, past president of the Canadian Club. And questions, do we have any? Raise your hands, please. And Mr. Kelly will be pleased to answer them. I think you should step up here, and I'll step aside.
Thanks, Ellen. Okay, not all at once, and your limit is 5 per person. It's a great turnout.
Thank you. Yes, my question is in regard to the health improvements that you were talking about in the U.S. Can you share what you think is going to be some of the biggest challenges for the new president in terms of making that dream realistic? So could it be like resourcing of getting enough doctors that take several years to get into the force, or is it going to be infrastructure, or what do you feel is going to be the biggest challenges that he'll need to overcome?
I'm certainly not an expert on it. I was on a hospital board system in the Carolinas for 4 years, and we did talk about it a lot, and we did do comparative studies between countries to talk about the future of healthcare. The U.S. healthcare system is absolutely fabulous if you're rich. You know, if you've got money, you have instantaneous access to anything you want and everything you want, and you don't have to wait a year for a hip replacement. You can have it done while you're in outpatients 5 minutes after it's been diagnosed almost. It's amazing. You can actually have CAT scans on little mini ones that people buy to put on the corner of their desks. It's absolutely astonishing. I suspect that part of this, it's an inefficient system, I suspect, because of the fact that it's private. And I can tell you, my wife's here today, and our son had to have an operation 6 or 7 years ago. And boy, we were exposed to the complexities of the U.S. insurance system. It is astonishing. It's very tough, and I remember thinking how easy it was to get health care in Canada and how uncomplex. It's very complex south of the border. So I don't know how it will play out. I really don't. But I suspect in the end, part of it is going to be more co-pays, and I think part of it is going to have to be that profit margins for providers are going to be lower, and I don't see a way around it. And I suspect that in the end, Americans may have to it's going to be painful, but I suspect that availability of services are not going to be as instantaneous as they were in the past. It's going to be a very tough debate. Other questions?
Bob, has anyone taken a look at current house prices in relation to replacement cost? I mean, that's got to be a big influence at some point.
You're absolutely right. A good friend of mine just bought a place in Delray in Florida. That he has money and he always wanted to own a place in Florida. And he said, in the end, this thing is so much lower price than replacement cost. And he's going to live in it for 10 years or use it for 10 years. He's pretty excited about it. So I do think you're starting to see some people starting to do that. But you got to be careful, though. I think you can get tricked by replacement cost because that variable can change rather rapidly. So I think it's relevant. What I am mindful of, the thing I love the most in terms of research that I've done on this and I've heard people talk about is Texas. Texas went through a terrible, terrible recession in '83, '84, and housing prices completely tanked. And I was speaking to a CEO some months ago in Los Angeles who's in the oil business and originally from Texas, and he described one day where his executive assistant came in and said, have I missed something here? I pay this much in rent. I can buy a house, have this down payment. If I factor in these utilities and taxes and maintenance and stuff, isn't this a lot cheaper than my rent? And the answer is, yeah, it is. And that arbitrage is coming. So I think the rent versus owning arbitrage is going to be a very good story at some point this year. There are going to be people that will hold back because they're going to still wait for housing prices to bottom, and those prices may dip through that arbitrage price. But one of the stories we heard every day in the U.S. over the last 5 years, and I'm sure you heard it a lot in this city, is young people can't afford to buy a home reasonably close to the city so that they don't have a horrific commute. Well, young people will be able to afford to live a little closer to town, which is an upside. Any questions?
Bob, you spoke about the TARP being a useful plan, and you certainly are right that they had to move quickly. But for those of us north of the border, it does look as if the U.S. government has decided to get the least efficient institutions and give them the most amount of money. So the worse managed they were, the more TARP you got. And you mentioned this point that only 25 banks had failed, and we probably need to have 1,000. Isn't all the action the U.S. government taking delaying the inevitable, which is significant bank closures, significant bank consolidation, and the use of the TARP is really slowing that process that we really come to expect from the U.S., that ability to rejuvenate and start again?
Well, personally, I'm a big believer in, and you've raised a good point, I'm a big believer in consolidation in financial services in the U.S. There was a time where the U.S. had 20,000 banks, and consolidation has been going on for many, many years. The cost of intermediating between loans and deposits, it's another thing you taught me, Robin, thank you. The cost of that is just too high per person in the United States. And I think there should be more consolidation. You should assume that the administration, the Treasury, and the and the Federal Reserve Board they do think about that issue. And in fact, one of the issues they've been trying to grapple with is they don't want to artificially prop up banks. And there's unintended consequences of everything you do, of course, from a policy standpoint. And there were a number of banks that said, okay, if I'm not getting the money, that means I'm not going to make it. And that's created a lot of complexity for a lot of cities and states and for the federal government as well. I think consolidation is going to happen anyways, and actually the TARP money may actually help accelerate it a little bit because it makes it a bit easier to have a stronger capital base to allow you to take the restructuring costs against it. So I would expect to see more consolidation, and generally it happens because of two reasons. The first one is your economic model doesn't work anymore as for your company, or secondly, you have a succession issue. And I think we'll see more consolidation over the next few years. We're not doing well on this side of the room.
Hi, Bob.
Michael, how are you?
Good. Bob, do you foresee the U.S. mortgage product, residential mortgage product, changing to remove the embedded option to refinance, although the market may make that unnecessary anyway, but perhaps making it more similar to a Canadian mortgage product that reprices periodically?
Well, great question. I did see Secretary Paulson make a comment last week at a conference that he thinks the future program should be basically a guarantee program, not an on-balance sheet program, and I'm very supportive of that, quite frankly. And I think there is a role for Fannie and Freddie, but a different role. One of the things I did some months ago when I tried to think about longer-term stuff is I did a comparison of the English-speaking world, basically Canada, U.S., U.K., and Australia. And the U.S. offers for homeowners basically the lowest rate, the longest-term product, mortgage interest rate deductibility, and inability to go after other personal assets if you have a problem, et cetera, et cetera, et cetera. And yet our home ownership rate in the U.S. is not that materially different than the other three countries, or Canada's in particular. So I'm not sure the cost of it has been made sense. The U.K. eliminated mortgage interest rate deductibility when I was living there in the mid-'80s, and I don't think it hurt the housing system. And there's no question that it makes the option you speak of to refinance, a free refinance option, makes it very difficult for banks and other financial institutions to hold those instruments on balance sheet because you can't manage your risk. So I suspect the products will evolve. So will the role of Fannie and Freddie. It's going to be fascinating. The system here works, and you should be proud of it. And it's a little more expensive, and you can't get a really long-dated product. But in the end, it achieves the policy objectives for the country, in my view. And you have a strong country. Other questions? One here? What time for one more only? Sorry.
Great. I'm just going to ask you actually, sorry, can you see me?
Yes. Hi.
Great. In the United Kingdom, we've actually just launched a gender mainstreaming analysis of the economic crisis. Clearly there's going to be a gendered aspect to the economic crisis and to the fallout from mortgages being lost, etc. And so that's what the British government has done to find out whether women are going to be disproportionately affected. Is there any sort of analysis like that being occurring?
I'm sorry, analysis like what?
A gendered analysis to look at whether it is in fact the case that all people are going to be affected by some of the factors that you have identified in your own talk today, or whether it's in fact the case that women and children are going to be disproportionately affected. And just one of the factors that the British government has outlined is the fact that women are disproportionately presented in lower paid jobs.
I haven't seen it, and the UK economy is such an unusual place. It's from the standpoint that it's mainly about southeast England, of course, and the housing market in the UK tends to be more volatile than the U.S. housing market because it's so concentrated in the southeast. I haven't seen the data in terms of ownership by men and women. I do know there were huge excesses, like in the U.S., on some of these products. It's not unusual to have a 120 mortgage. You have 120% of the value of the home, so you can buy furniture and stuff like that and get into the house. And so historically, if you look at the mortgage curves over time, you can see there's much higher highs and much lower lows. And it's certainly in southeast England, when you pull out London and the metropolitan area around the M25 and the M3, you do see that they're more stable. But the problem the UK has right now is that by far the biggest industry in their biggest city is under extraordinary duress. And that's going to be really tough, which means that housing prices are going to be pretty painful for quite a while. And we'll just see how we come through it. Well, thank you very much. I very much appreciate having the opportunity to do this.
Thank you, Mr. Kelly, and thank you all for joining us here today. Obviously, a great deal depends on the success or failure of the administration of incoming President Barack Obama. And it would be difficult to think of an American president of whom so much is anticipated, even before he's taken office. Obviously, he'll need all the help he can get. That will include some far-sighted and sage leadership from the U.S. banking sector. And as Robert Kelly has stated, the American retail banking system has been changed and needs to change even further. It may eventually look more like the one we have in Canada. Here in Ontario, we don't need to be reminded of the vital link between our province's economic well-being and that of our southern neighbours. And in 4 or 8 years, Canada and the United States will still be one another's most important trade partners. Prime Minister Trudeau once said that living next to the United States is like sleeping with an elephant. No matter how friendly and even-tempered is the beast, one is affected by every twitch and every grunt. I think Canadians, and indeed most of the world's people, sincerely wish the American elephant the best of health in the future. So much depends on it. And to that end, we wish good luck to the new American president as he takes on his most difficult and historic task. And now, on behalf of the Canadian Club and on behalf of the President who had to leave, thank you again, Mr. Kelly, and thank you all for coming here today. This concludes our television programming, which will be broadcast live on Rogers TV. This meeting is now adjourned. Thank you.